Hello, everybody. This is Noah and John, and we are with UrbanDigs. And Johnny, we are talking Manhattan today, and we got a good one as always. Today we got Jill Preschel from Serhant, and she is just producing and producing and producing. And we got her here for ourselves. I think she's just under $3 billion in transaction, around 2.7, I think was the number she whispered in my ear just before this. Did over 60 million in sales in the last year or so, a tough year. Did one of the highest sales of the week, acknowledged by the Olshan report, which we always love over here at UrbanDigs, and has worked extensively in a lot of new developments. And again, we got her to ourselves for 15 to 20 minutes. And Jill, you're in the hot seat. I'm going to come right in. I'm going to ask you straight up. The people want to know what is going on in the New York City real estate market today.
Yeah, that's the big question. What I'm experiencing is really that the luxury real estate market in Manhattan and Brooklyn is really dynamic, exceptionally nuanced. And that was just the end of 2024. I assume it's going to continue that way into 2024, into 2025 rather. And over the past couple of years, we've really seen this significant shift influenced by these macroeconomic factors. We've seen a shift in buyer preferences and inventory levels. So it's been, for me, since I've been doing this since 2007, really interesting, really, really interesting.
So I have to say, so the word dynamic can really cover up a lot of sins, right? It can mean a market that's really moving. It can mean a market that's also really challenging. And I'd like to dive into some of the different markets because, I mean, Jill, from your seat, I mean, you see some incredible action. And I'm curious on that new development front, because it's one of those markets that's really opaque unless you're dealing in it. And I'd love to hear your thoughts on what that new dev market is like today.
Sure. The new development market is an interesting one where you have these core markets that always perform consistently and steady. Greenwich Village, you're seeing these new developments launch in pre-sales and the homes sell at a rapid pace. We're sometimes seeing new developments sell, 70% or so even before TCO, which is great and consistent with what we saw in 2012 and some of the stronger markets. What I would say is where there have been disappointments with new development is when the pricing isn't commensurate with the product. And then really you need to adjust and pivot very fast. So West Village, Greenwich Village. And then of course there are also particular developers that just know how to develop for their market. Naftali is one. And so his developments are always a home run, always a home run.
Yeah, I figured it's a very nuanced market in that development world. You mentioned 2012, Jill. Do you feel like the environment today is similar to 2012? I mean, I recall 2012 as being a low inventory marketplace.
The reason why it is and it isn't, that's a great question. When you deliver new development in these prime neighborhoods like a Greenwich Village or a West Village, it's moving as fast as 2012 because of the low inventory. However, if you're not in one of these hot spots, it's sort of like whack-a-mole, If you're not in that hot spot with the right product and the right pricing, you're gonna just languish unless you adjust the pricing. And we're also seeing that similarly for some townhomes in Brooklyn as well. It's performing similarly that way. We had a buyer that wanted this asset on Garfield Place. It was very particular interiors, but they loved it. And we sort of said, either the market will respond really well because it was priced under the market, taking into consideration that someone would have to do a massive renovation, or it would either sit there. And sure enough, multiple bids. We had to bid $1 million over list to get it with an escalation clause. And I was actually very persistent with sweets and kind notes.
And I imagine, that's a rare kind of a thing that's happening? That's not a common occurrence.
Well, again, it's sort of like whack-a-mole. You have to find these hot spots where the assets are priced well in prime markets where you know that the asset will perform consistently and steadily over time, that you're not at risk to see a big drop in value. And those assets are so few and far between because inventory is so lean that when they come to the market, you have to be ready to sort of fight your way through to get it.
Yeah.
Yeah.
It's a little crazy out there.
It's really interesting because that's, I think, one of the clear differences between the run up, 2012 to 2015 peak and right now. And you talk about, on the new dev side, buyers signing contracts before there's even a TCO, right? There's a hole in the ground, they'll sign up for it. Now, maybe you get that at some of the peak markets, but not necessarily in all the markets. And, your discussion about the townhouse in Garfield Place, I get it, right? It's a prime piece of property. You're going $1 million over and people want it. And I'm curious, on the other side, if you're not necessarily in those prime areas, but you're a seller, even in this low supply environment, can you talk about some of the challenges that those sellers might see who are not necessarily the best located or the best priced, or, developers who might be sitting on, empty units in maybe not the hottest neighborhood? What does the market look like from that perspective?
That's trickier to navigate, right? You said it really well. If you're not in a premier market and the home is sitting, that's the market speaking to you. Where that becomes problematic is a lot of the developers underwrote these assets 2, 3, 5 years ago. Nobody has a crystal ball. It is a bit like gambling, right? Educated gambling, in that you're projecting forward the data and hoping and hoping. So very often when those assets are sitting and you can't reduce the price, well, what can you do? You have to sort of get really, really creative about how you sell. And we're seeing that across the board with sale inventory as well. That's tricky for everyone.
It is tricky. I'm just curious
Yeah.
if there's any kind of, at what point is the discount between, say, a prime neighborhood and a non-prime neighborhood? At what point, I'm wondering, does that trade clear? Like someone says, oh, it's a 20% discount, for, say, I don't know, like
Delta's huge.
Midtown
Yeah.
East versus Chelsea. Like, I'll take it. I'm just curious how that plays out now versus in the peak time.
I'm scared to give numbers, but the delta's huge. Delta's huge. So for an asset in a prime neighborhood that's priced well, we're actually seeing it perform maybe at this point 25% higher than the rest of the market, which is great. And then if there's something that's languishing, I'm seeing the opposite, sometimes 15, 25%
Right.
performance below market.
Yeah.
Painful.
Could
It is
I just
painful, yeah.
pivot to the buy side real quick and ask your thoughts about, are there any advantages to being a buyer out there today? I mean, low inventory. I mean, prices did come down, but I feel like they've recovered a little bit,
Yeah.
high rates. I'm not sweetening the pot here. I'll tell you that much.
I think it gets really tricky because you have to sort of think about the buyers in segments, right? To your point, a buyer that's maybe a first-time buyer, maybe they're looking up to 2 million, they're financing. That's a very tricky market to navigate. Low inventory, high rates, maybe they've outgrown their current home. What do they do? The rental market's pretty tight. That's really tricky to navigate. And that's absolutely, I think, where the value of a good broker comes in, trying to find that treasure, that off market through their broker networks, understanding the buildings and the neighborhoods inside and out. And then I would say your $3 to $5 million buyer maybe has a little bit more, maybe more liquidity, maybe a little bit more options. I recently, it was about a year ago, had a buyer that had a much larger budget, Uber luxury. That was a lot of fun because there aren't that many buyers out there that are in the Uber luxury bracket. So those homes that are sitting on for 800 days in the market, you can get really big discounts. And if you're not worried about your sources to fund a purchase, well, then this is your market. Have fun.
Right. So the biggest advantage is really those mispriced sellers out there that are just lingering, basically.
Yeah.
I just have to ask you a quick follow-up, because you talk about the Uber luxury market, which to me is it's a super interesting thing, because again, like new development, it's like one of these really opaque things, and unless you're dealing with it, you don't necessarily have a sense of how it moves. And I mean, Jill, you've been in this industry long enough to kind of watch that market develop because you've been in it. And I'm curious, when you look back at, say, 2000, the 2012 or before, what did that Uber luxury market look like then versus what are the people in the Uber luxury market looking for now? Are there any similarities, differences? I'm just curious how that market has evolved over the last, 15 plus years.
Yeah. When I was at Alchemy and we were selling 35 West 15th Street, which was in this prior cycle you're referencing, I remember this vividly. We had an 18th floor unit that was really two units, 18A and B. And the chairman of a major company in the United Kingdom happened to walk by the building, called up, and we did a deal. And it was a combo, and it was $13 million at the time. That was sort of might have even have been a record for that neighborhood at the time because it was before the Walker Tower. And that was sort of crazy, right? Like someone just walks by on the street, calls the sign, and we do this combo deal that was over 10 million. That was sort of a crazy time, but inventory was low. And even at the Woolworth, when we were in pre-sales at the Woolworth, when I was at Alchemy, we had a $50 million full floor combination during pre-sales. So people are going in an internal hoistway through a dark tunnel, walking a construction site. It's just concrete and views. And okay, I would love this home, right? That was sort of that market, low inventory, uber high net worth individuals.
On the marketing side, though, going up that hoistway dark tunnel, I mean, come on, that has to be that's like guerrilla marketing to the extreme, right? I mean, that really sells it, right?
Not when you're riding with me and I'm holding on for dear life, sort of squealing like an animal. I really do not enjoy that.
I love the hard hat tours. I don't know why. I love those things back in the day.
I recently toured one of the new construction in Williamsburg that my friend of mine is selling. And at one point I just said, because it was an external hoist and we were going up to like story number 30 or 35, just said, I'm a mom, I'm going back down.
Yeah.
It
could get a little scary.
40, yeah.
Especially when you sign that document, like if you die up there, it's not their responsibility. By the way, but go have a great showing of your floor.
Go ride 40 stories on the external side of a building. Yeah.
All right, Jill. I pretty much got a sense of where we are now. When you look ahead, I'm curious what you see for the new development market, but like also what are you monitoring? What are you watching for? But like I really kind of want to hear what your thoughts are on this sector. Is there any pipeline going on? Or is it just going to be like this for a while?
There are developers that are building their pipeline very strategically in these core neighborhoods in Brooklyn, in Manhattan, and they're being more thoughtful about pricing. Capital's really difficult right now. It's so expensive. A lot of the developers are struggling to be able to get capital to even build their pipeline. So the ones that are doing it very thoughtfully. So this next round of new development that come out in the next 2 to 3 years, I feel will be priced really well. And then just looking ahead at what we'll monitor, the economic factors, understanding what's happening with inflation, the stock market, really impacts buyer and seller confidence, and also the international buyers, sort of monitoring that, what's happening on a global, because they play a really significant role in the Manhattan market, whether it's for investment purchase or to build their portfolio. We are seeing them gradually return, which is adding another layer of demand, which is fantastic in many aspects, but also as inventory is a bit limited, it can make it a little trickier too. And I think sellers and developers should keep an eye on the shifting buyer preferences, sensitivity to absolute dollars, an interest in wellness-focused amenities, flexible layouts, outdoor space, energy efficiency. I've seen a real awareness as far as energy efficiency and sustainability.
Awesome.
Yeah.
Awesome.
The local law 97 stuff, I think, has really come back to bite a lot of the developments that were, even the developments that are only like 20 years old now are you're seeing grades of D on them, and they're looking at pretty massive upgrades in order to get their efficiency requirements up to the A level or whatever you're supposed to get. It's a really tricky thing. But I guess, Jill, what I wanted to just quickly follow up, because you mentioned something really interesting. You talked about the cost of capital is higher. And one of the things that we like to talk about is, on the macro side, we've been looking at the 10-year rate, and, the current narrative is that as it approaches 5%, it's going to start breaking things. And I'm wondering, from your perspective, because, you do have this sort of panoramic perspective of the new dev market, as well as that luxury market. Do you see any pushback in terms of what the cost of capital is going to be doing to the market? And if you want to put your prognostication hat on, do you see like a slowdown in development because of the interest rates, or is it more generally driven by demographic changes? If there are buyers, there is going to be building kind of thing.
What you had initially said, that capital's being capital is expensive, it's hard to come by, there's a scarcity of it, that is creating a situation where developers are being more strategic about trying to build out their pipeline because they don't have as many ways to fund it. So you're absolutely right. That's what I'm seeing. And even my connections with capital guys, when I'll reach out to them, because I do have quite a network of folks that play in that space, I'll say, hey, I have this person, I'd love to introduce you. They've bought this asset or they're thinking of buying this asset. Would you like to be connected? I got a great response recently that was sort of like, Jill, if you just think I'm just sitting on a whole pile of cash, like, was it Scrooge McDuck or whoever that cartoon character was?
Yeah, I love that
show. Yeah.
Those gold coins that they dove into.
Yeah, exactly. He's like, if you just think that's what I'm doing, that's not. We are no longer offering that service. And so a lot of people have sort of just turned that off for the time being. And so the developers that are buying and building their pipeline are being more strategic. So yes, there's less that we're seeing in the pipeline, but it will likely be priced thoughtfully and built thoughtfully.
But that Schedule A could change, right? I mean, it could be priced thoughtfully today, and then in 2 years when it comes out, I guarantee you, Jill, if the market's higher, they're going to go do a little adjustment and reissue a Schedule A. But that's the way the markets work.
Yeah, you're right. Today it's priced well. Tomorrow, who knows?
Yeah. I mean, it is what it is. Really, really, really interesting. This has been awesome. I have one last follow-up question for you, and it's regarding business growth, general strategy. We like to ask the question, if you ran into your younger self for the first time and you had a chance to give yourself a tip because you're new to the industry or because you're trying to get to the next level, what would you advise your younger self, or what would you advise a new agent or even an agent that's experienced trying to get to the next level, maybe meeting some challenges and is trying to realign focus and readjust their strategy? What would you tell them?
I love that question. For me, I would tell my younger self or someone who is, just starting out, to look around the landscape and look at their business alliances, look at their connections, look to people that are doing something that they seem to love, that they're passionate about, that they seem to have expertise in, and go have coffees with those people. When I just started out, I think I was not as aware that that was something that people would be open to. And it's a great way to just learn and deepen relationships and just craft that 360 view in a more substantial way.
Coffees. Just coffees. Just
coffee.
Can I take you out to a coffee and pick your brain for a little bit?
Yeah.
And Jill, did you, because I know you graduated from Johns Hopkins, did you go right into real estate? Is that your first career after college, or?
So I went to Johns Hopkins and did generations of surgeons in my family. And I was actually in a haute couture showroom for a Venezuelan fashion designer who no longer has his label. It was very cool.
In Baltimore or in New York?
In New York.
Okay.
He had gorgeous dresses, but after probably 2 months, I realized, while it's something that I'm interested in, it wasn't for me. And my sister was working at Corcoran Sunshine, so I thought I would dabble in that. And I started on the weekends at Lucida.
Oh,
love that development.
I love the Lucida. It's like that
development.
I would like to say it's on my block. It's about a mile away from my block, but still, like it's a really fantastic building. I mean, it's one of the beauties of Upper Lexington.
It's gorgeous.
It is gorgeous.
Yeah, and you worked on a lot of really, really, really nice buildings. So you know what? Listen, I really appreciate your time, and I really appreciate you coming here to share your wisdom and what you're seeing out there and your observations, and your advice to your younger self. This is all good stuff. Get coffees with your
I like that,
with your mentors. Yeah. I mean, today's day and age, it's like the mentor is going to look at it and be kind of like, in a positive way, they'll look at it. I feel like back in the day when I started, I was like scared to ask them.
Me too. I was.
Just do it. John, any other final questions for Jill?
No, Jill, thank you very much. This has really been wonderful.
Thank you for having me. This has been so much fun for me. And I wanted to also say I love UrbanDigs and I use it so much.
Awesome.
So much.
Oh, well,
That's
that is
cool.
just an added
Especially-
bonus.
Yes, on listing pitches, because all of that data is so extremely helpful. So I live and breathe in those charts. Those are my jam.
I love it. Thank you so much.
Awesome.
Well, Jill, thank you for telling us that and making our day over here ending on a high note. And again, thank you again for taking your time and talking to the audience about what's going on in the state of the markets. Excellent, excellent stuff. Jill Preschel from Serhant. That is John Walkup. I am Noah Rosenblatt. This has been Talking Manhattan, and we will catch you guys next time.
Thanks.